Let us start with the concept of financial markets. We have already discussed in the previous chapters that every business needs funds or money to finance both its assets and its activities. There are two sources of funds for any business: owners or investors' funds and borrowed funds. Owners or investors' funds means the money brought in by the owners of the business. In a company, the owners or the investors' funds will be brought in by way of equity share capital or preference share capital. Borrowed funds means the money that is borrowed by the business through loans, by issuing debentures, by accepting deposits from banks or financial institutions, or by accepting deposits from the public. What about the profits generated by the business itself? Can't it be a source of finance? Yes, it can be. But technically, the profits generated by the business belong to the owners or the investors of the business. So, profit generated by the business, which is not given out to the owners or the investors, but retained by the business itself, either as reserves or retained earnings, is also classified as owners or investors' funds. Next, let us talk about the savers or the investors. Most of us are savers because we save a part of our income, which is the surplus funds left over after our expenses have been taken care of. Some people who have access to larger amounts of money may be investors. The main difference between savers and investors is the risk that they are willing to take. A saver may typically have a smaller sum of surplus funds, so they don't want to take unnecessary risks. They may invest in a bank fixed deposit, which will fetch a small amount of return. An investor may have a larger amount of funds and they are willing to take a higher level of risk, and they may invest in shares or in debentures or in company deposits, or may even give out loans to various businesses. The higher the risk that the person is willing to take, the higher the returns that may be expected. Now you have businesses which need money, and you have the savers and the investors who need to invest their money and earn returns. This is where the financial markets come in. They are the medium that connect the savers, the investors, the banks or the financial institutions, and the businesses. Financial markets allocate or direct the savers or the investors' funds into the most productive investment opportunities. Here, banks and financial institutions are both financial markets and they are also investors. As financial markets, they collect deposits from savers and provide loans to businesses which need money. So, banks perform an allocative function. As investors, banks may invest in various companies as shareholders, which is why some banks are also called investment banks. In a perfect world where everyone has perfect information and takes perfect decisions, the financial markets can perform perfect allocative function, where savers and investors get the highest possible rate of returns for their money, and the financial resources are allocated to the most productive businesses. But in reality, perfect allocative function is very, very rare. Banks and financial markets, which collect the funds from the savers and the investors and provide it to businesses, perform the allocation of funds. This allocative function is also known as financial intermediation. So, banks and financial markets are called financial intermediaries. As a saver, you have a choice of either investing your money in a bank fixed deposit, or you can go through the financial market and directly invest in a business for higher returns, of course at a higher risk. If you deposit your money in a bank, the bank will give you 7% interest and give that money as a loan to a business at say 13% interest. And the difference is the bank's profit. The businesses which are participating in the financial market want you to bypass the bank and directly invest with them as a shareholder or a debenture holder or as a depositor. In which case they will have access to funds at a cheaper rate than through a bank loan. You as the investor will earn a higher rate of return than through a bank deposit because you are taking a greater risk. So here the banks and the financial markets are competitors or competing intermediaries, because both are competing to attract your money. A point to remember here is this term, financial market, is a generic term. Any platform or any process which connects savers, investors, banks, financial institutions, and the businesses is a part of the financial market.